Greetings. I hope you're all well. What I want to talk about today is the change to the cash rate that was declared by the Reserve Bank of Australia on Melbourne Cup Day this week, that is on Tuesday, just 2 days ago. And I want to talk about that in the context of what it means to investors and what they can expect going forward in terms of the likely returns and yields from investments, certainly in terms of investments put on the platform by Zagga in terms of its investment loan products. So I'm going to share with you very quickly a very interesting slide that was published by the Australian Financial Review. And what that slide shows us is the movement in the cash rate since 2006. You can see that the cash rate peaked somewhere around the end of 2007, 2008, but has really steadily declined to where it went earlier this week at the beginning of November 2020, where the rate was cut by a further 15 percentage points down to 0.10% or 10 basis points. That is the lowest cash rate we've seen in Australia ever. And it looks that it's going to remain that way for some time to come, as I believe that the Reserve Bank of Australia is reticent to promulgate negative rates, as was the case in Japan and certain other places for quite a long time. But 0.1% is really about as close to nothing as you can get. I see that in the press this morning, some of the large banks have indicated that they don't intend passing on this cut to their mortgage customers, and I don't think that that's surprising. The banks are all suffering from a profit point of view and will take any increase or widening of their margin that they can get, although some of the smaller home loan lenders have taken the view to be aggressive and to pass on the cut as best they can. That said, I see that the cheapest rate currently being offered for a home loan in Australia at the moment is 1.95%. I'm not suggesting that anyone's going to qualify for that, but that's certainly the advertised rate, and a home loan rate of under 2% is certainly not something that many of us would have forecast going forward. In fact, it appears now that having a fixed home loan rate is probably more beneficial to you than having a variable home rate, certainly for a year or so going forward. By the way, I'm not giving you financial advice in that regard. I'm not telling you to go and change your mortgage rates if you have a mortgage. I'm just observing what I've read in the financial press over the last couple of days in the context of what I want to say. So if you do have money in the bank, and with a bank rate or interbank rate or cash rate of now just 10 basis points, the likelihood is that any deposit rates are going to be reduced at least by this amount. And to the extent that you've been earning already around 1 or slightly under 1% on your money, the likelihood is you're now going to be earning a lot less on your money. Just before I go on to what that really means, I'd like to take you on to two other slides, which I found really interesting this week in some research that was published by CoreLogic RP Data, who are really, I would say, the go-to guys for real estate and property information. And in the first graph, which you can see here, they're plotting real versus nominal changes in residential market rates for the September 2020 quarter. And as you can see there, the nominal rates are in the dark blue, the real rates are in the lighter blue. And if you look at the Sydney market in real terms has shrunk by 3.2%, the Melbourne market by 4.2%, and the only markets really to have increased, although nominally, are Darwin in the Northern Territory by 1.7% and Australian Capital Territories, Canberra area, for 0.1%, which is almost nothing. But on a combined basis, the real change in dwelling rates for the September 2020 quarter was a shrinkage of 2.6% or negative growth of 2.6%. That is probably a lot less than is our perception out there in the market. More interesting, I would say, is the chart underneath, which are the March to September dwelling market rates, where if you again have a look at the real terms, Sydney is down 2.1%, Melbourne is down 5.1%, but many more of the regional markets are up. Brisbane is up marginally, Adelaide is up, Hobart is up, Darwin is up, and ACT is up. But on a combined basis, the combined capitals are only down 2.2%, but on a national basis, the combined national dwelling market throughout COVID, effectively from March to September, is only down 1.5%. And again, I would suggest to you that that is much less than is the perception out there for most people. Now, the last chart, and perhaps the most interesting chart, and again, the one that I think is going to be relevant to the comments I'm about to make, is really nominal versus real returns as at September 2020, plotted for 10 and 20 years. So if you have a look at Sydney, the real return over 10 years in Sydney in residential property is 33%, and over 20 years is 76%. In Melbourne, it's 14% over 10 years and 106% over 20 years. Hobart, 17.7 and 113 over 20. But I'm more interested in showing you the combined capitals and combined Australia. So the combined capitals over 10 years are 11.4% up, and over 20 years, 79.4% up. And Australia overall, over 10 years is 7.7% up, and over 20 years is 73.3% up. And that's research from CoreLogic RP data. Now, what's the point of the research I've just shown you and of the graph I just shown you regarding the cash rate? Well, the point I really want to make is as follows. As you all know, our loans are all underpinned by a first registered mortgage over property. Many people are concerned that property is going to be an unstable asset class, that property prices are going to decline, that there's going to be a property crash. And all I'm suggesting to you from the research that I've just shown you is that perception is not reality. In fact, in reality, the Australian property market throughout COVID has not performed at all badly, with a negative growth of 1.5%, which is really very, very little under the circumstances. And if you consider that the average LVR across our platform is around 60%, a shrinkage of 1.5% still leaves you a lot of room to maneuver on your LVR. And secondly, that over both 10 and 20 years, across just about any sector you want to look at, but specifically across Australia, and more particularly across the capital cities, property prices have in fact increased. The returns have been positive and are likely to remain positive. Now let's just turn to investment yields for a second. Right now, across our platform, we're probably showing loan returns of somewhere around 8 to 8.5%. As you all understand, our returns are risk rated. Each return is set for the specific loan scenario in which we are investing in on your behalf. And each of those is underpinned by a credit assessment score, which is determined by our credit team. On the other side of this coin, borrowers are certainly not stupid. They're very savvy. They read the same research and papers as we do. They're connected in the market. They understand where the market is at from a price point of view. And with the rates dropping the way they have, and we've now seen rates drop by 1.75% over the last year or so, borrowers are certainly not going to allow themselves to be paying in the 9s or 10s, or maybe even in the 8s for their loans. We, of course, only want to write quality loans, and we want to deal with quality counterparties. And that means we're probably going to have to look to reduce our borrowing rates to borrowers to fall in line with expectations of the market and to make sure we always get the best possible deal. Against that, we understand that yields are coming down. So I think that you can expect going forward that rates are going to move, certainly on our platform, from the 8s into the 7s. We certainly see among some of our competitors that they're already in the 6s. And I saw recently that 360 Capital have put together a residual stock fund, which is putting up a return in the 6s. Qualitas has recently restated the earnings for its listed property fund to in the 6s. And Balmain Private, which is one of the largest, most well-established and longest standing of the private lenders, is now also offering returns in the 6s. That's not to say that we will blindly follow the competitors into the 6s. We will always set what we consider to be the best return that we can get for our client under the circumstances. We set those out very transparently, and we disclose those in our information memorandums to our investors. But I think it is fair to say that the days of returns in the 9s and even in the 8s are now gone, and we're going to be seeing returns into the 7s and maybe into the high 6s. To put that in context, if you're going to be earning 0.5% or thereabouts for your money in the bank, or maybe even less, then earning somewhere between 6 and 7% for your money is still an exceptionally good return. And it's underpinned by an exceptionally strong asset, which I've shown you is likely to hold its value over time. So that's really the message I wanted to impart for today. Obviously, if you have any questions, if you have any concerns, if there's anything more that you would like to know, feel free to email us on info@zagga.com.au or to email me at alan@zagga.com.au, and we'll be delighted to answer your questions. We've been absolutely blown away by the support we've had over these last few months. We've picked up many, many new investors, and we're grateful to all of you for your support and trust. Obviously, also to our existing investors for their support and trust. Everything is going as well as can be expected in pandemic times, but there's certainly nothing that you need to be concerned about in terms of any of the loan investments in which you are currently invested. We will continue to look for the best loans at the best returns with the best credit metrics that we can find for you. And if we can't find those, we simply won't be offering loans on the platform until such time as we can find those that meet our quality, assurance, and integrity tests. Stay safe, keep well. It's great news that borders are beginning to open. Great news that we may have somewhere to go on holiday at the end of the year. But Zagga will always be around. We'll be here to answer your questions and look forward to hearing from you.